China comes back tonight, and $88 silver has been waiting for 2 weeks. Shanghai was silent while the West watched. Silver got slammed, knocked down, again and again, and every single time, it came back. Now tonight, the dragon wakes up, and what happens in the next few hours could change everything. You thought you understood this market? You haven't seen anything yet. Welcome to Financial Crisis Explained, the one place where the numbers tell you the truth. Now, before we go further, if you've been with us for a while, you already know what this channel does. But if you're new here, think of subscribing, like putting on your reading glasses. You wouldn't sit down with an important document and leave them on the table, would you? Hit that subscribe button. Don't let the algorithm decide what you miss. And one more thing, where are you watching this from tonight? Are you in London, Karachi, New York, Dubai, Lagos, Toronto? Drop your city in the comments below. Because tonight, where you are in the world, might matter more than you think. 2 weeks. For 2 weeks, the Shanghai Futures Exchange sat silent, closed for Lunar New Year. No Eastern bids, no Chinese institutional weight, no price discovery from the world's largest physical silver consumer. And yet, silver didn't collapse. That silence, that absence of one of the most powerful market forces on the planet, should have been the perfect window for price to fall, for the bears to take control, for the suppression to stick. It didn't, and that is not a small detail. That is the entire story. On the day of recording, Western spot silver was sitting at $88.50, not because the market had an easy ride to get there, not because buyers simply overwhelmed sellers in a clean, orderly fashion. It got there by surviving. Multiple times throughout the session, silver was knocked back down to an $85 handle. Not once, not twice, multiple times. Coordinated selling pressure pushed price down, and each time the market absorbed it. Each time buyers returned, each time price climbed back. By the time the cameras were rolling, silver had reclaimed $88.50 on Western spot. Now, here is what serious analysts and strategic thinkers must understand about that sequence of events. When a market gets hit repeatedly and refuses to stay down, that is not luck. That is not sentiment. That is not retail enthusiasm. That is structural demand. The bids underneath that price are real. They are patient. They are large enough to absorb sustained selling. And they are not going away. For any entrepreneur or business decision maker watching this, understand what that pattern communicates. It is the market equivalent of a company that keeps getting hit with bad press, bad quarters, regulatory scrutiny, and yet its fundamentals keep pulling it back. At some point, you stop asking why it keeps falling. You start asking who keeps buying. Silver did not move in isolation. The broader precious metals complex was sending a coordinated signal. Gold on Western spot was sitting at $5,228. 2 trading sessions prior, both gold and silver were meaningfully lower. Over those 2 sessions alone, gold climbed approximately 4%. A significant move for an asset of that size and liquidity. Silver, over 11% in the same window. Let that number settle for a moment. While mainstream financial media was discussing quarterly earnings, rate expectations, and equity valuations, silver quietly moved over 11% in 48 hours. That is not a commodity twitch. That is a repricing event. And then there is Bitcoin. Over that exact same 2-session window, the window where gold surged 4% and silver surged 11%, Bitcoin went down. This is the detail that many casual observers will miss entirely. When hard assets move violently upward and the most prominent speculative digital asset moves in the opposite direction, capital is not rotating randomly. Capital is making a statement. It is moving away from speculative risk and toward monetary anchors with 5,000-year track records. For young entrepreneurs building financial literacy in real time, this is the lesson. Markets do not lie. They may distort temporarily. They may be manipulated in the short term. But capital flows at scale always reveal the truth eventually. And in this 2-session window, the truth was visible to anyone paying attention. So as tonight approaches, as Shanghai prepares to reopen for the first time since the Lunar New Year silence began, the Western market has already told its side of the story. Silver absorbed repeated attacks. It recovered. It held. Gold surged alongside it. Bitcoin diverged. And 2 weeks of Eastern demand, Eastern positioning, and Eastern price discovery are now preparing to enter the equation. The question is no longer whether pressure was building. The question is what happens when the valve opens. Shanghai comes back tonight, and the market has been waiting. There's a moment in every market cycle when price stops moving like a commodity and starts moving like a chess match. That moment is right now, and if you don't understand what is happening inside this price structure, if you're reading the surface and missing the architecture beneath it, then you're not watching the same market that the serious money is watching. So let's fix that. The map was already drawn. In the session prior to tonight, the resistance zone was identified clearly, precisely, without ambiguity, $87.20 to $89. That was the battlefield. That was the ceiling that price needed to crack through. Not touch, not test, not briefly pierce, but crack through with confirmation. Right now, as Shanghai prepares to reopen, silver is sitting inside that zone. And that single fact, price camping inside resistance rather than closing decisively above it, is carrying more strategic weight than most market participants realize. Here is why. When price enters a resistance zone and lingers, it is not automatically a bullish sign. It is a conditional sign. The condition being this: does price close above the zone with conviction, or does it stall long enough for the opposing side to reload? Because right now, while the bulls are holding their ground at $88.50, the shorts are not panicking. They are reloading. Every hour that passes without a decisive body close above $89 is an hour that disciplined short sellers use to rebuild their positions, to add pressure, to prepare for another attempt at suppression. This is not speculation. This is price structure mechanics. And it has played out this exact way, in this exact type of zone, across decades of market history. Why a wick is not a victory. This is the part where financial education becomes genuinely critical, not just for traders, but for any entrepreneur who will one day read a balance sheet, evaluate a market entry, or decide when to commit capital. There is a fundamental difference between a wick and a body close. A wick is a moment. It is price reaching a level briefly, sometimes for seconds, before retreating. It shows interest in a level. It does not show conviction. A body close is an entirely different statement. It means that when the clock ran out on that hourly candle, when all the noise, all the buying, all the selling, all the repositioning settled, price held above that level. It did not retreat. It did not give back the ground. It closed there, permanently, on the record. For the resistance zone of $87.20 to $89, what this market needs is not a wick above $89. It needs a body close above $89, not a momentary print, not a flash, a close, a confirmation, a declaration that the zone which was once overhead resistance has now been converted into support. Until that happens, the zone is still doing its job, the ceiling is still intact, and the structural advantage still belongs to the side that is patient enough to wait for confirmation before committing. The sequence that follows, a real breakout. Assume for a moment that the body close comes. Assume Shanghai's reopening tonight brings the Eastern institutional weight that has been absent for 2 weeks, and price responds. What does the road ahead actually look like? The next structural level is $90, not a psychological round number chosen arbitrarily, a level where historical price memory exists, where previous reactions occurred, where the market has unfinished business. Beyond $90, the next significant structural target is $92. And beyond that, if momentum sustains and volume confirms, the door opens for continuation into territory that would represent a genuine generational repricing of silver as a monetary asset. But none of that conversation is relevant yet, because right now, the only number that matters is $89. And the only thing that matters about $89 is not whether price touches it, it is whether price closes above it. What this teaches beyond the chart. For the business community watching this, there's a lesson here that extends far beyond silver futures and candlestick analysis. Every serious decision in business has its own version of a resistance zone, a threshold that separates genuine commitment from temporary enthusiasm. A line that separates the entrepreneurs who almost broke through from the ones who actually did. And in business, exactly like in markets, a wick doesn't count. Almost launching the product doesn't count. Almost closing the deal doesn't count. Almost committing the capital doesn't count. The body close is the only thing that goes on the record. Silver is sitting at $88.50 tonight, inside the zone, absorbing pressure, waiting for Shanghai. The next hourly candle could change the entire conversation, or it could give the shorts exactly the time they need. Either way, the zone will tell the truth. It always does. Every market has a heartbeat. Some days it is quiet, a slow rhythm, predictable, almost forgettable. And then there are nights like tonight, nights when something shifts, when a force that has been absent, deliberately, structurally, calendrically absent, returns to the room, and the entire room feels it. Tonight is one of those nights, because China just walked back in. Understand what 2 weeks of silence actually means. Most casual observers looked at the past 14 days and saw normal market activity. Silver moving, gold climbing, Western futures doing what Western futures do. What they missed was the weight of what wasn't there. For 2 full weeks, the Shanghai Futures Exchange was closed. Lunar New Year, China's most significant cultural and economic pause, had pulled the world's largest physical silver-consuming nation completely out of the price discovery process. No Shanghai bids, no Chinese institutional positioning, no Eastern futures pressure, No physical delivery demand from a civilization that has treated silver as a store of value for thousands of years longer than modern financial markets have even existed. And here is what makes tonight genuinely extraordinary. During those 2 weeks of Eastern absence, during a window that should have been the perfect environment for silver to drift, to weaken, to surrender ground, silver went up over 11%. Think about that with the seriousness it deserves. The world's largest physical silver consumer was completely absent from the market, and silver still climbed 11% in 2 sessions. Still absorbed repeated suppression attempts, still refused to break, now that consumer is coming back. Tonight, for the first time since Lunar New Year, Shanghai reopens. The numbers that were waiting at the door. When the Shanghai Futures Exchange closed 2 weeks ago, it left behind a specific set of unresolved tensions, positions that couldn't be adjusted, demand that couldn't be expressed, price discovery that couldn't happen. That pent-up energy doesn't disappear during a holiday closure, it accumulates. At the time of recording, Shanghai spot silver was sitting at $86, Shanghai futures at $88 in direct alignment with Western futures pricing. That alignment is significant. It tells analysts that Eastern and Western institutional players have been watching the same levels, reaching similar conclusions, and preparing for the same moment. But alignment at the open is only the beginning of the story. What matters is what Shanghai does in its first session back. Whether Eastern institutional sentiment confirms the Western rally, or whether it introduces friction, whether Chinese buyers treat $88 as an entry point, or whether they treat it as a level to sell into, that answer will arrive tonight, and it will carry 2 weeks' worth of conviction behind it. The volatility signal that most people ignored. Buried inside the broader price action narrative is a number that deserves far more attention than it received. Silver's COMEX implied volatility index broke above 100. For context, implied volatility is the market's own internal measurement of expected future price movement. It is not an opinion. It is not a forecast. It is the aggregate positioning of sophisticated institutional players expressing, through real capital, how much movement they are preparing for. When that index breaks above 100 for silver, the market is not expecting calm. It is pricing in violent movement. It is telling anyone willing to listen that the participants with the largest positions and the most sophisticated models are bracing for a repricing event. Not a gradual drift, not an orderly climb, but a structural shift in how silver is valued. This is not retail enthusiasm driving that number. Retail investors don't move implied volatility indexes. Institutions do. And right now, institutions are paying serious premiums to protect themselves, or position themselves, for what comes next. For young entrepreneurs building their understanding of how global capital actually moves, this is the education that no business school teaches in its first year. Implied volatility is the market's honest voice, and right now that voice is not whispering. It is speaking at full volume. The geopolitical layer. Underneath, the price. Here is where the analysis must go deeper than charts and closing prices. China's return to the silver market tonight is not simply a calendar event. It is not just the exchange reopening after a scheduled holiday. It sits inside a geopolitical context that is impossible to separate from the price action. China has been systematically increasing its strategic commodity reserves. Silver, which sits at the intersection of monetary history and industrial necessity, occupies a unique position in that strategy. It is not purely a financial asset. It is not purely an industrial input. It is both simultaneously. It is used in solar panels that power China's energy transition ambitions. It is used in electronics manufacturing that underpins Chinese export dominance. It is held in vaults as a monetary hedge against dollar-denominated reserve risk. When China buys silver, it is rarely buying for just one reason. And that complexity, or that multidimensional demand from a single nation-state actor with the world's largest foreign exchange reserves and a multi-decade strategic planning horizon, is what walked back into this market tonight. What the dragon's return tells serious decision makers. For the business community watching this analysis, the lesson is not to rush into silver positions based on one evening's price action. The lesson is to understand what kind of market force just re-entered the equation. When a market absorbs 2 weeks of Eastern absence, climbs 11% anyway, holds critical technical levels under repeated suppression, and then the absent force returns with 2 weeks of accumulated demand pressure behind it. That is not background noise. That is a signal worth understanding at a fundamental level. Because the same principle that governs commodity markets governs business markets, capital allocation decisions, and economic cycles. Absence creates accumulation. Return creates movement. And tonight, after 2 weeks of silence, after 14 days of tension building quietly beneath the surface, China has returned. The Shanghai Futures Exchange is open, and silver is no longer trading without its largest player in the room. What happens next will not be quiet. It never is. when the dragon wakes up. Everything covered so far: the resilience, the resistance zone, the body close, Shanghai's return, the volatility index, the capital rotation away from Bitcoin and into hard assets. None of it exists in isolation. It is all pointing at something larger, something that serious decision makers, entrepreneurs, business builders, capital allocators cannot afford to misread as a trading story. This is not a trading story. This is a monetary system story. And the difference between those two things could define the next decade of your financial life. What 88 silver is actually saying. When silver trades at $88, after years of institutional suppression, after decades of being dismissed as the poor man's gold, after being consistently undervalued relative to its industrial and monetary utility, it is not simply quoting a price, it is making a statement. That statement is this: the mechanisms that kept silver artificially constrained are losing their grip. The paper market that allowed silver's price to be managed through futures positioning is being tested by physical demand at a scale that is increasingly difficult to absorb. For any entrepreneur who has studied how monopolies eventually break, how dominant market structures eventually face disruption from forces they underestimated for too long, this pattern should feel familiar. The suppression of silver's price is not a conspiracy theory. It is a documented, mathematically observable feature of how paper futures markets interact with physical commodity supply. And what the market is showing right now, through 11% moves in 2 sessions, through implied volatility above 100, through repeated recovery from suppression attempts, is that the balance of power is shifting. Not overnight, not in a single session, but structurally, irreversibly, in the way that genuinely significant market transitions always move, slowly at first, then all at once. The historical precedent that should command attention. This is not the first time gold and silver have surged simultaneously while speculative assets declined. History has a pattern here, and it is worth stating plainly, without exaggeration, without sensationalism, with the calm precision that serious economic analysis demands. When gold and silver move aggressively upward in tandem, when the move is sustained across multiple sessions rather than being a single spike, when implied volatility confirms institutional positioning rather than retail speculation, when simultaneously the most prominent speculative digital asset declines, history suggests the market is pricing in something systemic. Not a recession, not a correction, not a quarterly earnings miss, something systemic. The kind of repricing that occurs when a sophisticated capital, the kind that manages sovereign wealth, pension obligations, and generational family wealth, begins to question the stability of the broader monetary architecture. Gold at $5,228 is not a number that exists in a vacuum. It exists in a world where sovereign debt levels are at historic highs, where central bank credibility has been repeatedly tested, where the dollar's role as the unchallenged global reserve currency faces its most serious structural questioning in 50 years. Silver at $88, moving 11% in 48 hours while Shanghai was still closed, is not a number that exists in a vacuum either. These numbers are talking to each other, and the conversation they are having is one that every serious decision maker should be listening to. Bitcoin's decline, the signal inside. The signal. The Bitcoin divergence from this 2-session window deserves its own focused moment of analysis. There was a time, not long ago, when Bitcoin positioned itself publicly and confidently as digital gold, as a monetary hedge, as a store of value immune to the inflationary pressures that erode fiat purchasing power. That narrative was never universally accepted by serious monetary economists, but it gained enough traction to attract significant capital, including institutional capital that might otherwise have flowed into precious metals. In this 2-session window, the window where gold climbed 4% and silver climbed 11%, Bitcoin went down. This is not a permanent verdict on Bitcoin as an asset class. This analysis does not make that claim. But what it does reveal is this. In the specific moment when the market began pricing in genuine monetary system stress, when capital began moving decisively toward 5,000-year stores of value, Bitcoin did not move with gold and silver, it moved away from them. For entrepreneurs and business builders who have allocated portions of their treasury or personal capital into digital assets as a monetary hedge, that divergence is worth examining seriously, not emotionally, not reactively, seriously. Because if the monetary stress thesis that gold and silver are currently pricing in continues to develop, if this is the beginning of a structural repricing rather than a 2-session anomaly, then the question of what actually functions as a monetary hedge in that environment becomes one of the most important capital allocation questions of this decade. The 2 weeks that built this moment now synthesize everything. 2 weeks ago, Shanghai closed. Eastern demand, the most consistent, most voluminous, most structurally significant physical silver demand on the planet, went temporarily offline. During those 2 weeks, Western markets continued trading, Silver absorbed pressure, gold climbed, implied volatility built quietly above 100. Institutional players positioned themselves. The resistance zone between $87.20 and $89 became the battlefield. And underneath all of it, underneath every session, every suppression attempt, every recovery, 2 weeks of Eastern demand was accumulating. 2 weeks of Chinese institutional positioning that couldn't be expressed through Shanghai was building behind a closed door. Tonight, that door opened. And what walked through it was not just renewed price discovery, it was 14 days of compressed conviction. The framework for serious decision makers. This analysis ends as all serious economic analysis must end, not with a recommendation, not with a call to action, not with a price target dressed as a prediction. It ends with a framework. For entrepreneurs and business decision makers operating in this environment, the framework is this. Understand that commodity markets, monetary metals, and capital flows are not separate from your business reality. They are the water your business swims in. When that water changes temperature, when gold reprices by 4% in 2 sessions and silver by 11%, the change eventually reaches every business, every balance sheet, every capital allocation decision. The entrepreneurs who thrive in monetary transition periods are not the ones who predicted the exact price. They are the ones who understood the direction early enough to position their businesses, their capital structures, and their strategic decisions accordingly. Silver is at $80 tonight. Shanghai is open. The volatility index is above 100. Gold is at $5,128. Bitcoin diverged. The market has spoken. The only question that remains is whether you are listening carefully enough to hear what it is actually saying. Because the window to understand this moment clearly before the next move makes it obvious to everyone is closing. And in markets, exactly like in business, by the time something is obvious to everyone, it is already too late for everyone.